In this video, we'll talk about a simple yet very popular tool of volume analysis, the volume profile. At the same time, it's important to understand that while this tool looks simple, it is actually very powerful and can significantly improve trading. The key is to use it correctly. We'll start by looking at how price interacts with the key zones of the volume profile, and by the end, we'll discuss some advanced methods of combining it with additional indicators. Let's add a volume profile to the chart. Its main settings are the classic value area of 70% and the point of control, POC, which is the price level with the highest traded volume. In this example, the POC is highlighted in green, and the value area is the range where 70% of the day's total volume was traded. This indicator doesn't always need to be built from the start of the day. It can also be applied to custom periods, which is particularly relevant for indices or instruments that don't trade around the clock. However, in our case, we are looking at Bitcoin futures, and we'll build the profile for the entire trading day. Our task in this lesson is to study how the price reacts to important levels such as point of control, POC, value area high, VAH, the upper boundary of the balance zone, value area low, VAL, the lower boundary of the balance zone. In simple terms, the lower boundary, VAL, represents a price considered cheap compared to the previous day, so market participants often activate buy orders there, pushing the price back into fair value. The upper boundary, VAH, represents an expensive price, where many participants may look to sell back toward balance. Even at a glance, you can see examples of such interactions. For instance, here the POC acts as a resistance level. Price reacts to it and then moves downward. For this video, let's take a straightforward approach. We'll turn off the static daily profile and instead use the dynamic volume profile to track how price reacts to the previous day's levels. You can easily apply the dynamic volume profile using this button on the toolbar or with the hotkey D on your keyboard. Of course, you can customize the hotkeys to fit your workflow. Now, to keep our analysis objective, let's separate the chart into trading sessions. We won't consider the Asian session, but we'll focus on price reactions during European and US trading hours. Here's the first situation. Price moves down during the session, dropping below the value area. We then see a reaction in the form of a wick back into the range, followed by a strong reaction at the POC level. We can mark price movements relative to the areas of interest from the previous day's volume profile. And later we'll see, using additional indicators, where realistic exit points from a position could have been. We're not focusing on specific entry models here, but even just looking at how price moved, we can clearly see a break of structure. For example, there was an upward trend, and at this point the uptrend was broken. Somewhere around here, a short position could have been opened. If we had waited for confirmation with this candle's close, the move down could potentially have been captured. From there, it comes down to backtesting. Do you aim for 1-to-1, 1-to-2 risk-reward, or some other format? For now, we're only observing price reactions. Let's move to the next day. We plot the volume profile for the new session and study how price interacts with the levels of interest. Once again, we see that price reached the POC, point of control, then formed a range. In this case, there wasn't a clear exit point. The only possible short would have been here, after confirmation, but that would have resulted in a potential loss. Later, price bounces from the point of control, breaks through the value area high, and shows a strong move up to current levels. Moving further, price interacts with VAH again, then once more here, before finally breaking out of balance upward. A confident consolidation above balance occurs, and price rallies strongly into the end of the day, more than 2% growth. Next day, again we shift the profile forward. That way, we keep tracking yesterday's key volume levels while analyzing the following trading session. This time, during our trading hours, we clearly see a reaction at the upper boundary of the balance zone. Price opened, dipped below the previous day's balance, and then reacted to VAH. If we had taken short positions here, there was the POC level acting as support. In such cases, it makes sense to move the stop to break even once price reaches significant support/resistance zones. Then we had the weekend. If a large amount of volume was traded over the weekend, those levels can still be used, but in general, major initiations tend to happen on weekdays. On the next day, the 11th, Monday, we see a large move. Interaction with the value area comes only near the end of the day, which doesn't really fit our approach.
However, traders familiar with market profile will recognize a classic open rejection reverse relative to the volume profile. That gave an opportunity to trade a move back toward balance. We'll revisit this setup later. Continuing with the next day, the 12th, we open and immediately test the lower boundary of the balance zone during trading hours. Price reacts and moves up about 90 ticks.
Later, price approaches the lower boundary of the value area, breaks through it, and continues to move. Once we break below this zone and consolidate, we see a reaction up to the POC level. This could have been a potential trade. For example, a 1-to-1 risk-reward setup was achievable here. Again, from the previous day's POC, we see another price reaction to the volume area. Remember, we're not talking about entry models here. The focus is on how price reacts to volume zones and how you can integrate this method into your own trading strategy. For some traders, this approach can be very useful. For example, after opening, price reached the balance zone of the previous day and reacted strongly from the POC following the breakout of this level. This gave an excellent move, several percent. We saw a breakout from the previous day's balance, a breakout of local highs here, and a strong upward trend of nearly 4%. Moving forward, once again, we have the previous day's balance and volume profile. Price opens high, moves toward balance, then drops further. Internal levels start to form, and from the upper boundary of the balance zone, we see a reaction downward, all the way through the lower boundary and even beyond. Altogether, the move was more than 4%. Toward the end of the day, there was still a solid reaction of around 1.7%, about 200 ticks with a price step of 10. Looking at the next day, price opens around the value area, trades inside the balance for a while, then breaks through a local range and exits the value area. From this movement, the asset gives another 140 ticks from the balance zone. Next comes the weekend. 2 weekend days can be combined into one composite profile. As expected, there wasn't much volume. Moving forward, we don't see any strong interaction with the value area. Price doesn't quite reach balance. Now let's consider the 19th. The instrument opens and interacts with the balance, here and again here during our trading session. After consolidating, price slides below the POC, drops beneath the value area low, breaks through local levels, and continues downward. The following day is more choppy. Price pushes upward and consolidates in this range. An attempt to break higher here would likely have resulted in a loss. Later, price slides under the balance zone, consolidates below it, confirmed by this candle close, and then we see a reaction down to val. From there, price gives another move down, about 1%. Later, price once again breaks above the value area high, giving a small move upward, but overall the day is quite choppy. Most likely, this day would have resulted in losses. Let's move on. We've looked at basic price reactions. Now let's discuss some advanced information. We can add the clouds indicator to the chart, which highlights large trades, single big ticks, and observe where these volumes appear. Here are the indicator settings. Single trades of 120 contracts are displayed. We can see that during breakouts and at extreme points, clouds often appear. For example, during a breakout, as the market pushes higher, a large trade comes through. After the move is already in progress, often near the climax of the move, we see big buys appearing. This could represent volume entering to break through prior local highs. But for us, this is a climactic signal. suggesting that it would be logical to either close the position or at least move the stop loss to break even. So, the appearance of clouds acts as a secondary confirmation tool, helping us understand what's really happening in the market and make better trade management decisions. For example, we had a volume profile breakout. When price retraced toward the value area, large trades came in at the market and price reacted upward. Another attempt to push price lower was again met with heavy buying volume, and the reaction was up. For us, this kind of behavior increases the probability that price will break through local levels, and that's exactly what happens. Once again, when a local level is broken, we see it accompanied by large market orders. At the end of big moves, we often see single large prints, clouds, which can signal climax. At these points, it makes sense to either take profit or tighten stops. For example, after consolidation, stops were taken out once, then twice, and on the breakout, we again see a large single trade, signaling the move is ending. Similarly, here, after volume appeared at the breakout high, the move faded. If we were holding long and large volume appeared at the very top, it was a signal the move was ending. Another example, price breaks local highs with big volume, a climax, followed by a reversal down. Or price tries to break lower. Heavy selling volume hits the market, but price reacts upward, showing absorption.
Finally, we push higher again, and at the peaks, we see increased volume, another sign of exhaustion. Next mode, cumulative volume. Here are the settings. Accumulation starting from 180 contracts, range 400 initial ticks, fast accumulation 1 millisecond. Again, let's observe where volume clusters appear. We had a profile forming near the boundary. Then, market buys came in, and price dropped lower. On the breakout of a local level, volume appeared, and the reaction was down. At the end of the move, we see selling activity. These could be stop losses being triggered, selling at the lows by traders who had previously bought higher. As a result, the move stalls. Another example. We were holding a position, volume appeared at the high, and the move stalled. During breakouts, again, large volumes came in, price pushed upward, many participants bought, and then heavy selling occurred. What the clouds indicator shows us is that large clusters of market trades came in at those points, but despite that, price often reacted in the opposite direction. For instance, volume appeared, price rejected the value area high, and reversed lower. At the very bottom, the low, large selling trades appeared, and then price moved upward. Clouds often appear at turning points. If clouds appear at the end of a move or during a breakout, the move can still continue for a while. Now let's look at another advanced indicator, cluster search. In its current alpha version, there is a combined mode, which searches for clusters with both high volume and large delta, the joint condition. Once we display this indicator, the logic is the same. Looking at candles, we see that at the end of a move, there's a cluster with very high volume and large delta. For example, volume equals 428 contracts, delta equals negative 249. Such an event signals that redistribution of volume is taking place. Why? Because sellers are aggressively pushing with heavy market sells, negative delta, but volume is being absorbed. This means the market has run into limit orders. Despite strong selling pressure, price does not fall further. As a result, the reaction is upward. For traders holding a short position, this kind of high-volume, high-negative delta cluster is a sign of climax. On the other hand, if we were long and a large cluster appears at the top with big positive delta, it shows exhaustion of buyers, and price stalls. During breakouts, clusters with high volume and large delta also appear, often followed by a test of the level. Price breaks out, large cluster appears. Then a retest occurs, and an upward continuation follows. So we see the same logic. Large volume plus large delta clusters often mark key turning or continuation points. In summary, we can combine clouds, large single trades, cluster search, volume profile levels to create a robust trading system with solid expectancy. But as you can already see, price reacts consistently to volume zones.